In 1951, a young Warren Buffett had 65% of his net worth in a single stock. That stock was Geico Insurance and went on to grow at a compounded rate of 25% per year for 20 years. To put that in perspective, that means that a $15,000 investment would have compounded into $1.3 million in just 2 decades. In today's video, I'm going to explain to you what made Geico such a great investment with the help of an article that Buffett wrote about it when he was just 21. I'm also going to explain the big mistake that Buffett made, which limited the success of his investment. And finally, I'm going to explain how you can do the exact same thing in your portfolio. I put a ton of effort into this video, so if you do enjoy it, I would very, very much appreciate it if you could hit subscribe or just leave a comment down below. Even at the young age of 21, Warren Buffett was following very similar investing principles to the ones that he uses today and the ones that he teaches to everyone around the world. And those areas are circle of competence, economic moat analysis, management, and margin of safety price. Buffett first heard of Geico when he found out that his mentor, Benjamin Graham, was the chairman at the company. At the time, Buffett knew absolutely nothing about the insurance industry, but as you do when you're keen to learn, he jumped on a train all the way down to Washington, DC in order to visit the company headquarters. While there, he was fortunate enough to meet with the president of the company's assistant, who sat with him for hours and explained how the auto insurance business worked. Later that year, Buffett started buying Geico to the point where 65% of his net worth was invested in the company. Then he wrote an article for the column The Security I Like Best, where he detailed the characteristics of Geico that made it such a great investment. The first of Warren Buffett's investing principles is to invest in companies with wide economic moats, long-term competitive advantages that ensure the company will thrive. From his newfound understanding of the industry, he discovered that almost everyone who purchased a car also bought insurance, which meant the industry itself is likely to survive over the long term. The industry also requires no inventory or raw materials, which is yet another significant cost advantage over other industries. Then Buffett starts talking about specific advantages that Geico had over other insurance companies within the industry. Geico had no agents or branch offices, which gave them a huge cost advantage and allowed them to price insurance at a 30% discount to the rest of the market, while also maintaining 27% profit margins compared to the 6.7% of the industry average. But Warren Buffett didn't stop there. Once he had qualitatively come up with an opinion about the competitive advantages that Geico had over other companies, he then needed to see it backed up in the data. From 1936 to 1950, Geico grew revenue at a compounded annual growth rate of 36%. Cheekily, he takes a shot at Wall Street and short-minded investors who believe that a growth company is one that's on a short run of high growth, stating that Geico is a legitimate growth company based on the following record. That record being 14 years of double-digit growth even through multiple periods of poor economic activity. He then goes on to say that, of course, today's investor does not profit from yesterday's growth, which means that despite the impressive track record, investors need to look forward to the opportunities in front of the company. At the time, Geico was only licensed in 15 out of 50 jurisdictions, and for example, in New York State, there was only 3,000 policy holders, which gave Geico a lot of opportunity to expand across the United States, let alone globally. The next of Buffett's principles is to look at management, the people making decisions on behalf of investors. Benjamin Graham had been the chairman of the board since his investment trust started buying a significant amount of the stock in 1948. Buffett then looked to the president and noticed that it was Leo Goodwin, the man who had founded Geico 14 years back and had been running the company ever since. And the final convincing factor was that 33% of the company was owned by the 10 members of the board of directors. These factors tell us that management's priority is in the long-term interests of the shareholder. And this is because the founder obviously cares about the long-term success of the business that he built, and all of the other directors are significant shareholders themselves. The final piece of Buffett's strategy is to buy a great business at a margin of safety price, a price that offers a high reward while taking very, very little risk. The stock was trading at 8 times 1950 earnings of $3.92 per share, so assuming no further growth in the business, a shareholder's expected return would be about 12.5%. But 1950 was a terrible year for the industry, meaning that Geico's earnings were unusually low, and that, coupled with a terrific track record of growth and potential opportunities in the future to grow, meant that the company came with significant upside and very little downside. Later in his 1995 Berkshire Hathaway letter to the shareholders, Buffett explains how he turned a $10,000 Geico investment into $15,000 by 1952. Buffett's big mistake was that he then sold the stock to pursue another insurance investment. After he sold the stock, Geico continued to grow at a compounded annual growth rate of 25% for 20 years. The Geico stock that I sold grew in value to about $1.3 million, which taught me a lesson about the inadvisability of selling a stake in an identifiably wonderful company. Now, there are going to be a lot of people watching this who would love to go out and do the same thing that Warren Buffett did, but lack the confidence to take even a small slice of the success that Warren Buffett has built over his lifetime. Most of us aren't going to go to the lengths that Buffett did in order to learn about insurance, but we can look at companies in areas that we already understand. Companies that we love, companies that we work at, products or services that we use, or even investing in companies that have a small number of moving parts and that are easy to understand. Beyond that, it's just a matter of understanding Buffett's core principles and knowing how to apply them correctly. And if you want to learn more about the 4-step process that Buffett has used his entire life and that I've used and teach on this platform, then I actually put together a free 20-minute training video on my website to teach you those exact principles. You can get it via the first link in the description below if you're interested. But other than that, thanks everyone for watching. And as I said earlier, I would very much appreciate it if you did enjoy it. If you could hit the subscribe button or leave a comment down below or leave a like, do something nice, share it with a friend, do something that interacts with the video. I very much appreciate that at the very least. Thanks everyone for watching, and I hope you guys have a great day.